In this video, we're going to discuss what I call the holy grail of risk management. And the first thing you're looking at here is an example of some algorithmic trading we've put together with the strat. And this is actually running in real time. So we started running this not very long ago, and we're getting very similar results to what we see here. And you'll notice we start with about $50,000 account. It trades up into $57,000 in just about 3 months, give or take. I think it's slightly less. And this is risking 5% of the account per trade with about a 50% win rate. So it's not winning all the time. It's only winning half the time, but it's still making a lot of money. This is 14 to 15% in less than 3 months. That's a really good return. This is trading just shares on the NASDAQ stocks. So the question is, why is it still making money if it's only winning half of its trades? Well, the reason is this. What we'll notice is in the P&L curve, obviously it's going up, but when we look at the individual trades, you're going to see we have a lot more outsized wins above $100 and going up to a high of $633 versus our worst trade was minus $240. And you'll see most of the losers are less than $100 of losing, whereas most of the winners tend to hover around that 100 or higher range, especially the big ones. So when we look at the average win and average loss of the top 10 and bottom 10% of these trades, the bottom 10% of losers is very close to 100. The top 10% of winners is over 100, closer to $200 to $300 on average. So it's winning more when it's right, and it's losing less when it's wrong. This is the key to trading. You can trade good with a 30% win rate as long as your winners are big. So in the rest of this video, we're going to talk about the stop losses and the risk management that's used to add and reduce trades. In this case of this account, there is no adding, there is no reducing going on. It's simply holding winners and cutting losers fast, which is what we preach. So let's go and dive in. When it comes to stop losses, we've already talked about using levels of reclaim. If you haven't seen that, go watch the first video. I'll make sure the link's in the description. But in that video, we talked about how we want to time our actionable signals to occur after new lows. It's like if we have an inside signal, we want to time it at new lows to go through the previous range. If we have shooter signals, we want to time it back through this previous range after new highs. So when we're doing this, there's a few different stops that we can implement. The first is really simple, the low or high of the bar you enter on. And this is the one we suggest starting with, especially if you're not profitable. Because the tighter you can keep your stops when you're not a profitable trader, the less you have to lose to learn. So I'd rather you go in, lose 10 trades, very small trades, trading shares instead of options, and learn how the market's moving. Like, why did that lose? Was that analysis incorrect? Was it not a level of reclaim? Is it during an inside month and I shouldn't be trading it? You want to ask yourselves those questions and be like, why is this not working? Instead of going in, trading a ton of money, losing it all, and then learning why you lost it all afterwards when you have nothing to trade with. So the tightest level is we're going to use the low of that bar we enter on, or we can even go the spread plus 1 penny. And we tend to do that on really high volatility names. Now, the one that we tend to use the most once we know the strat is we tend to risk against the lows and highs that we are trading at. So if we take this inside signal, we can risk the low of this bar or this low, and we can target the other side of this range as our first target. So this would be our target 1 to take this out. This would be our entry price, and we could put our stop at the low of this bar, the low of this bar, or the lows right here. Any of these are proper. It's dependent on evidence, which we'll discuss a little bit of. The same thing's true on the bearish side, right? If we take a shooter, we're going to tend to enter at the break of the shooter. And since this is going to be a much wider stop, we normally don't even put it up here. We can use half of this bar or even the high of the bar we enter on, shying away from just using this. The bigger this, stop is, the less you can put in the trade. So we just want to make sure we're not going extremely wide, risking like 10% on shares when we're entering. Doesn't make sense. Now like 1%, 1.5%, perfectly fine. Now that being said, if we're timing these signals at new highs and new lows, our first target is always going to be linked into the broadening formation. So if we're timing this shooter here, our first target should be to take out all the way down here. Because imagine if this is a 30-minute time frame. We want to target this. If we're right, we want to continue to hold it. How do we know then if we're right? How do we hold the trade? Well, if it does not reverse, it's still going. Meaning, this was making higher highs and higher lows to the previous bar. Then it reversed to reversal. Lower highs to this high, lower lows to this low. Now it's going down. And then lower highs. Then we'll just say lower highs again, lower highs, and then higher highs right here, it reversed. So we're entering when it reverses, exiting when it reverses. And when we do it this way, you're going to see this is what it looks like, right? We're going to have a profitable curve, and we'll have some very small losses, right? You can see a lot of them around the $0 mark, the $100 mark, but the wins will be much bigger than our losses. And that's what's going to actually create this profitable curve we're looking at. So allowing the winners to play out. And let me show you. So you're going to see the average hold time here on a winner is 4.58 days. So the average hold time on a loser is 3.42 days. So the winners are held longer than the losers, allowing it to play out more. Now, if we were doing this on like a weekly time frame instead of a daily, this number is going to get much wider, meaning we're going to be holding it much longer and the losers will be cut much shorter. At this point, it's just a very, very simple algorithm we've created, and obviously you can see it works. Now, that being said, when we then dive in back to the charts here, when we're timing these signals, we also want to think about break even and cost basis. Because let's say we're looking at a monthly chart, which is how we start our trades. We have a monthly hammer signal, and we know all month it's trending up. What does that look like? Looks like an uptrend, right? It's going higher lows, higher highs. During that uptrend, what we're going to have is we're going to have the same thing. The reclaims back in the direction of that month. And the reversals, the slight lower lows, the reclaims back in the direction of that month. We'll say it looks like this at the end. So when we're doing this, we want to know how break even is affected when we add and reduce. So let's say, right, we have this reclaim. We take this signal at the beginning of the month. It goes, we hold. Continues, we hold. Continues, we hold. Inside bar, we hold. Reversal, we reduce or exit the trade. Every time it reverses, we're either reducing, exiting, or just leaving our stops even, depending on how far away it is. So since we had this nice winning trade here, if we had 100 shares, we reduce half of the trade. Let's say we make $10 a share, something simple. If we had 100 shares and we reduce half at $10 a share gain, we're going to make $500 on 50 shares. So we sell half of them. We now have $500 in our account. The other thing that happens is the trade is still open. We still have 50 shares. And those shares at this point, when we reduce, are still up 500. So we have 500 in our account, 500 still in the trade. Now let's just say hypothetically, the trade came all the way back to where we bought it. We have $500 in our account. The trade's back to where we bought it, so we have $0 in the trade. Therefore, we're still up $500. So our break even is lower now, lower than where we actually first entered. So we entered it here, reduced half. Our break even is going to be that same distance below our entry. This is our new break even stop. So when we reduce half, our break even drops dramatically. So what we can then do is enter, reduce to defend the winning position, and then keep our stop against this low. If it stops us out, we still make money. If it doesn't, we still make money. So it's a win-win situation. The only time it can fail is if you have a gap. And even then, if it gaps against you, you're going to lose much less because you don't have the full position size on. And then you wait. When this additional signal sets up with the reclaim, we do the same thing. We already have the 50 shares here, and we're already up 500 in our account. So when this signal breaks, let's say we're up, $7 a share on the 50 shares. So we're $350 still open and still up on that trade. Plus the 500, we're still up $850. So when we enter this, we can risk $850 on the ad. And technically it will be slightly lower than that, but you want to think, you're now playing with house money. You have their money in your account. So instead of adding back just 50 shares, add back 200, right? If this is right, you add back 200, you're going to make 4 times as much when this goes up versus if you did not add back. So we can add back, risking their money we already took, And what that will do is it'll take our break even from here. And if we add back, and we add back like 200 shares, our break even would probably go up to somewhere around here. So you'll see it will increase. But if we enter, we put our stop at our new break even point after adding to the position. If we're wrong, we don't lose money. If we're right, we are really, really, really right, and we make a ton. If this move here made us 1,000 on 100 shares, we have 250 shares, this move could make us 3,000. And we still haven't risked more of our money. We only risked the market's money on the ad. So this allows us then, we add to it, it reverses, we can reduce by half. So we had 50 shares after reducing half. Then we added 200, we had 250. So when we reduce half here, we now have 125 shares. And where's our break even? Well, if our break even was here after adding to the trade, we reduce half, our break even goes all the way down here. So now we have more shares. Our break even's even lower than it was when we added to the trade. And we can put our stops to the low of the month, which will allow this to play out. Then we can continue to look for more setups right here. Reclaim, buy more. We're up a couple $1,000s at this point. Might as well throw another 1,000 shares in there, risking their money, putting our stops against this. And then it goes, and now it's a $15,000 trade when it started as a $1,000 trade, just because you're risking the market's money. And this is what allows you to just hold. Like, people struggle a lot. It's something we've talked about in the Discord. They struggle a lot to hold positions, but this is how we need to think about it. And when I started doing this, this is what changed my trading and made it more fun, easier, less stressful, all of the above. So really important to understand adding and reducing. And the last part I can add in is when it comes to options, what you want to do is make sure you're in the money. So if you're trading this signal, ideally, you want to have something that will be in the money before target 1, making these new highs. So then it goes up. If you reduce half, you might be in a red position even above your entry. But since you reduced half, your break even is still going to be lower than whatever your entry was. And you also then want to make sure you have enough time. If it's a monthly signal, buy 2 months out. Give yourself enough time to be right, because then you can add and reduce and treat it kind of like a shares position. As far as some real world example here, we can go to AMD and we can see how we frame trades on a big time frame. So if you look at this daily, right? New low, hammer actionable signal. What do? It's a hammer. So we actually prefer to go tighter stops. So we can buy it. Let's just say we risk half the candle. And then we hold until it reverses. It reversed here. Again, when it reverses, we either have to reduce the trade, break even the trade, or exit the trade. Now, in this case, when it reverses 10, 11, 12% higher, is it more likely to come all the way back to where we got it? Or is it more likely to make some lower lows and then keep going? It's probably going to keep going. So we can either reduce or just hold, put our stops even and say, okay, I'm in from here. This is now my trade. So if your trade looks like this now, how can we add to this? Well, there is a lot of ads in here, but we could look at today. We go to the 5 minute, we zoom out. You're going to see the exact thing that we look for. So you're going to have lows here and lows here. Once it makes those lows and starts coming back, what's the ad? Looks something like this, right? You can use the 5-hour reversal, risk the daily open, risk the low here, whatever you want, right? We can even buy it when it goes green here and just risk this. But any way we can get in here, we can add to it. And then again, let it kind of grind up there. Maybe it's not a big trade. Let's just say we make $1 on here. Reduce the ad or exit the ad. Take your extra little money you just made. Your cost basis / break even is now a little lower. Or break even the stop and say, okay, well, if this works, I make a ton more. If it doesn't, hits my break even. If you're trading options, your break even will likely be a loss. Like in this case, if you're weekly options, it might be like a 20% loss at break even if we bought it, right here. So you just want to be aware with options, your break even will be different. So we want to be more aggressive on reducing options and making sure that we are in a winning trade. So in this case, though, you see it's still up about $2, right? It still hasn't came back to this entry or this 225 minute entry. And then if we're going to play it intraday, it's going to look for the same thing. You'll see there was some slight lower lows, goes up, hits our stop, so be it. Lower lows here, 2, 2, or 3 reversal. 2, 2, 2, and you can just walk your stops up intraday. So it's all going to work the same. Show you one more example. So Coca-Cola. This was one we picked up on yesterday and we're still in. This is what I did. So we saw this go green and then come back above levels of reclaim on the left, right at 68.58. So what we did is we just entered it because we can do that. We just put our stop daily open or low a day. We're like, okay, if this is green and it works, it's going to reverse 2-2 reversal. Where's it going to go? Well, if this daily goes 2 up, 2 up, 2 up, 2 up, our first targets is right here to make the new highs. Then second and third targets will be up and left much further. So the idea for the trade is this, to take all this stuff out. The first target would be to take this. So I traded in weekly options and I used the at the monies, or slightly out of the money. It was the 69 call. And I bought them right around in here. Then we took the daily reversal up and I just added to it because I had a 5 contract position. Then I made it 25 or 20 contracts. And then you'll see intraday, since I was adding to this position intraday, we go into target 1 and then we start doing profit taking. So all I did is I just reduced it by half when this went red. It's like, okay, I made my 70%. I reduced actually, I think it was by 75%. So not by half, 75% reduction. Since they're weeklies, you have to reduce more aggressively. And then I can just put my stop down here. And since I reduced 75% at a near 100% gain, even if the contracts go to 0, I still win. So in reality, my break even is if Coca-Cola goes to 0. That's an easy trade to hold, right? It's like super easy because if I'm wrong, I make money. If Coke delists, I make money. If I'm right, I make more money. That's where we want to be. And then as far as getting more entries, you know, you see on the 30-minute, there's slight lower lows. The signals in here makes the new highs for target 1, gives you a little bit, slight lower lows, right? And it's kind of inside day at this point, but they're starting to perk up a little bit. So you can see though, we want to enter trades, reduce, lower the cost basis, allow it to play out. And the last thing I want to add is when it comes to adding to positions, a lot of people will make this mistake. What they'll try and do, I'll just go to like SPY or something on the 1 minute. So let's just say SPY. So what they'll try and do is this. Let's say we create a position here. So we buy it and then you add to it and you let it come back and cause a losing trade. We never want that to happen. We always need to make sure when we add to a trade that our ad, the stop that we have on our ad, is above our break even. If it is not, you're going to increase the size of your losses. This whole risk management strategy, the whole goal is to not take big losses and to hold winners longer. So we need to make sure we're not adding into trades and then losing. And if you're a swing trader, right, you have that overnight risk. So you want to make sure when you're adding, you account for that. So if I'm swing trading, I'd prefer to swing a free position. It's just easier. If I'm going to swing trade and it's not a free position, I need to understand the risk that if it gaps against me and I'm in weekly options, they're going to 0. So I have to size for that specifically. That being said, that's all I've got for you guys in this video. So I hope you guys enjoyed. If you have any questions, drop them in the comments below and let me know. Do you prefer videos that are like this, no script, just kind of off the top of my head and going into the charts? Or do you prefer videos where we have the PDFs and everything included? Based on your feedback, I'll try and do either of those. If there's, a resounding yes on either of those ideas, but let me know. I'll see you guys in the next.